Very early, early in my career, probably 97, 98, I was lucky to invest in a security called TEMIT warrants. Now, that acronym TEMIT stands for Templeton Emerging Markets Investment Trust. Now, our next guest is the founder of Templeton Emerging Markets Investment Trust in 1989, and indeed the founder of Templeton, one of the first unit trusts in the world to invest in emerging markets equities. Dr. Mark Mobius. I'm really pleased to have him join us today, and especially given the focus of his new firm, Mobius Capital Partners, on a very unique and specific investment strategy. Mark has spent over 40 years traveling in and investing in emerging and frontier markets around the world. And in 1999, he was selected to serve on I'm going to have to read this, as the chairman of the Investor Responsibility Task Force on the World Bank's Global Governance Forum. Now, I think that puts him in a very unique and special place to be able to talk at responsible investing within emerging markets in general. As I mentioned, in 2018, Mark co-founded Mobius Capital Partners. And they have it's an active manager that has a very unique focus and single strategy, investing in emerging markets around the world, but using improving sustainability at the core of their investment process. Mark's authored many books, particularly on emerging markets, and his most recent book is on inflation, and we can talk a bit more about that in my conversation with him. But he also authored a book called Invest for Good, which has some incredible insights and some anecdotal insights from his time engaging with corporates around the emerging world, that is very entertaining and insightful for the readers and on the issues that are embedded in investing in emerging markets. So on that note, Mark, thank you very much for joining us today. I'd like to start by asking you a question of why was it you identified this specific investment strategy of sustainability-centered approach for Mobius Capital Partners, and how do you bring that to the fore, and possibly in conjunction with that question and your answer, can you describe what sustainable investing means to you and your colleagues at Mobius Capital Partners? Good morning.
Well, thank you very much for that nice introduction. For us, sustainability is really something that we have been looking at from the very beginning, when we started the very first emerging markets fund in the US in 1987. Excuse me. And it's really interesting that, of course, in recent years, ESG, environmental, social, governance, keyword, has become very, very popular. But if you look back in the history of our investing, at least in emerging markets, we always did pay attention to these factors, but we didn't label them as ESG. Excuse me. And the reason, the reason why we looked at these factors was in order to control risk. The key is controlling risk. And if you look at the investments we've made over the years, you'll see that in many cases we were caught out when something happened to the environment as a result of the actions by the companies in which we were invested, like mining companies. And we also were affected by social changes. For example, companies that we invested in had strikes and had too many firings and too many layoffs, which created social problems and a bad reputation for the company. And then when you get to governance, which is really our focus to look at governance, we found that in many cases, the boards of directors were all friends and family of the managing director, or they were not independent in any direction. So therefore, the path that the company took was not really very good in terms of growth for the company. So we decided to start a separate firm which would focus on engagement. In other words, engaging with companies in order to help them improve the ESG factors. Now, we also concluded that the most important of the ESG factors was the G, the governance. So any company in which we invest, we get commitments from the management that they will be willing to engage with us in a friendly manner in order to improve governance. And of course, that includes many, many things: independent board of directors, good communication with shareholders, et cetera, et cetera, et cetera. And with that, we can then impact the social and the economy aspects, and of course, the environment. So we are very, very engaged with each one of the companies in which we invest. We only invest in 30 or fewer companies, no more than 30 companies, so that we can really engage with them. We hold them for the long term, and we've seen incredible benefits as a result of our engagement, because share prices have gone up, partly because of this engagement that we've had and the improvements these companies have made in the way they govern their companies and the way they behave on the environmental and social spheres. So that's what we mean by sustainable investments. In other words, investments which do good for society, but also do good for shareholders, because the fact is that if you improve ESG, the price of the stocks will get better. In other words, you'll see an improvement in price. So it's a win-win situation. And this is becoming even more and more prevalent as more and more investors demand good ESG participation and performance.
That's an incredible introduction. So there's considerable evidence that companies who adhere to ESG factors or pay attention to their ESG factors will provide better outcomes for end investors. Is it always possible to provide good returns and good ESG outcomes concurrently? And then a follow-up question is, which areas do these two goals collide most prominently?
Well, interesting. There are more and more studies which show that companies that have high scores in ESG are doing better. In other words, the price performance is better. And we're finding this to be true with our own experience, but also if you look at companies around the world, this is the case. So the evidence is very, very clear, which is why more and more fund managers are recognizing this fact and are putting in ESG as one of their key factors. By the way, what we've also done in addition to ESG, we've added the C, which is culture, corporate culture. Because we found in looking at ESG, one thing that has been overlooked is the culture of the company. You can have good governance, but if the culture of the company is not in line with the objectives of the ESG components, then you have a problem. So we are also measuring culture. Now, of course, that's a very subjective thing, but we find that it's very important and important when evaluating companies.
That's a very good point there, Mark, and it talks to your comments on engagement earlier in the conversation. And so, do you have a view that active investors can be more engaging with corporate management and they have an advantage over passive investors when it comes to assessing culture, for example?
Oh, definitely, because if you're engaged, that means you're communicating with the company on almost a continuous basis. We are having phone conversations with our companies almost on a monthly basis, in which we talk to them about how they can improve their governance. And by the way, I've really been so gratified by the incredible reception we're getting from companies. Companies are really interested in improving the ESG because they're getting pressure from their constituents, from their customers, from their workers, and from their shareholders to improve their ESG characteristics. And of course, culture really cuts across all of these areas, because if you have a good culture in the company where people are cooperating, where the management is waiting to see what the reaction of their workers are, what the reaction of their shareholders is, then you're going to get a much better feedback and also better results on the ESG components. So we found that if you engage with these companies in a friendly way, by the way, we actually don't like to use the term activist because it implies sort of an aggressive orientation. We do not have that kind of orientation. We believe in a friendly, engaging way of working with companies. And if a company is not interested, then we won't invest. So we have to be very selective in the way we look at these companies.
And Mark, in the book, there's a great little story about your engagement with Turkish Airlines. Would you mind sharing that with everybody?
Yes, we were invested in Turkish Airlines, and one day we were talking to the managing director, and we told him, look, we've noticed that you don't have any independent board directors, because that time the company was majority owned by the government, Turkish government. And we said we'd appreciate it if we could recommend an independent director. Well, he said, frankly, I can't make that decision. You have to fly up to Ankara, the capital, and talk to my minister. So we flew up there and we met this minister. And by the way, Erdogan was just coming into office. And one of the good things that Erdogan did was bring people from the countryside into the government. And this gentleman we met looked like very plain-spoken. He had a suit on, but it looked like a few sizes too big for him. But he was very friendly. And we said, we'd like to humbly ask you if you'd like to have an independent director on the board of Turkish Airlines. And he said, why only one? Why not two? So we were so happy. And we got a board director on the board, a very capable businessman. And that resulted in a big, big improvement in the way Turkish Airlines was run. And as you know, today, Turkish Airlines is one of the best airlines in the world. And by the way, we also introduced a catering company to them. We found a company in Austria called Do & Co., which was run by a Turkish gentleman, excellent restaurant. And we introduced him to Turkish Airlines. Of course, they spoke the same language. And now he's doing the catering for Turkish Airlines. And if you ever fly Turkish Airlines, you'll notice the food is really excellent. So this is one example of where a friendly engagement can have a big impact.
I think that's a fantastic example where active engagement, not activist engagement, active engagement builds real world outcomes and builds far-reaching impact investing, if you like, that can't be comprehended from just on the face of it, any surveys that you fill out. Just to ask you a quick question, have you met with any company management where the time has just been fruitless or it's been a waste of time, or and also, if so, what was the rationale behind that? What were the kind of hindrances to that corporate management changing to be more engaging on ESG front?
Yeah, we've had a number of these cases where initially, we talked to the company and they said, or at least the president of the company was willing to engage. And this one example in Brazil, one of the things we told them, said, look, we noticed that your board of directors are all family-related people. And I think it's important that you get some independent directors. And he gave lip service to the idea, but then after a few months, no action was taken. And we asked him, what's the problem? Why aren't you getting independent director? He said, frankly, I have a family problem. The family has been on the board for so long and they're not willing to leave. And if I force them to leave, we'll have a big family debate. And so I'm not willing to do that. So we decided to sell the company. So that's one example where sometimes you can't be successful.
Thanks, Mark. And there's another story you shared with us where you were in Nigeria heading up to a meeting with an oil refinery company, and caught behind a lorry. And I'm just referring to this as your willingness to carry on engaging with that business, and how you're investigating the governance of the company, and whether and this talks to the culture as well. So would you just share that story with us?
Yeah, this was an oil company in Nigeria, and we were on the way to visit the management at their headquarters in Lagos. And it just so happened that our car was following one of their oil tankers, oil trucks. The tanker stopped, and some kids came running out with a pail and went behind the truck, opened the spigot to where the oil was, and filled the pail with oil, closed the spigot, ran away, and the truck continued on. So when we went to the meeting with the management, we said, gee, we've got something to tell you that you may not know about. There's a big evidence that we found of cheating, of your tankers being stolen. The oil was stolen from your tankers. And they said, oh, we know about that. We do that on purpose, because if we don't do it, these people would create problems for the trucks. They'll put nails on the street, or they'll deflate the tires or something like that. So this is an example of where culture comes in, unfortunately, where basically the somewhat corrupt culture results in a problem for the company, because they had to accede to the local requirements to allow these people to take oil in small quantities. It wasn't big, but it's a very interesting example where sometimes companies have to accommodate, and as shareholders, we have to understand that.
As you say, it's an interesting example of how you do need to carry on having those conversations to find out the investment opportunities or the improving opportunities of ESG factors amongst some of these businesses. Can we just move on to corruption? And I'm just going to paraphrase a quote from your book, Invest for Good. Corruption is more common in some countries and some companies than others, not because the people of some countries and companies are more corrupt, but where institutions such as property rights and the rule of law are weak or non-existent, corruption becomes rampant at the top and consequently becomes a way of life in many other businesses. Now, it's a very pertinent statement, but can you kind of bring it to life on how does this influence the way you invest? How can you assess this and then manage around it or improve it?
Yeah, it's a very interesting, very important question, because in many of these markets around the world, you have corrupt governments. And the question we have to ask companies in which we invest, how do you handle the government? How do you work with the corruption that you have in the society? And by and large, interestingly enough, a lot of these companies don't accede to the corruption. In other words, they're willing and able to work without getting into the corruption. And they do that in many ways. First of all, by steering away from areas where there'd be some corrupt practice, but more importantly, adhering to a very high standard. In other words, not willing to give in, even though it may lose some business for them. And we've seen that in many cases. And by the way, the U.S. Foreign Corrupt Practices Act has gone a long way towards helping the situation, because now any company, regardless of where they are in the world, if they're involved in corruption, they can be charged under the Foreign Corrupt Practices Act if they're doing any business in the U.S. So that has helped to some degree, and it's also made a lot of these companies stronger in their fight against corruption. In other words, their unwillingness to accede to the corruption.
Thank you. Having served as a director on many emerging market companies, and I believe that included Lukoil, the Russian oil company, how has that helped you focus on these environmental, social factors?
That's very, very important because when you sit on the board of directors, you get a lot more insight into what is really going on in the company, and you're pretty much on the spot. In other words, you've got to stand up and say, look, I think this is wrong, and we should not be doing this or that. And I found that by the mere fact of me being on the board as an independent director, the companies tended to be much more cautious in the way they behaved. And the mere fact that they wanted to have an independent director means that they really want to do the right thing. So my experience with Lukoil in Russia was very, very good. They followed the book. As you know, a lot of people don't realize that Lukoil had nothing to do with the Russian government in terms of ownership or anything like that. It's an independent company, but of course they have to adhere to the Russian rules and regulations, and they've done a very good job. The same thing is true. I'm on the board of Petrom in Romania, and again, the company behaves very, very well and has done a tremendous job in the country and has not succumbed to getting engaged in any kind of corruption.
I'd like to talk a bit about the portfolio, and you mentioned it was a concentrated portfolio. Does the focus on improving sustainability, does that lead to any sector or regional bias within the portfolio? And if so, do you believe that this is a permanent feature, or is it more transient depending on the current environment or the rate of improving practices in particular areas?
Yeah, it does actually have some impact. We pretty much stay away from the so-called sin stocks, cigarettes, gaming, things like that. And we also tend to stay away from resource companies that are doing mining, because there are so many risks involved. Now, it doesn't mean that we're going to stay away from them permanently, but if we do, we're going to watch very, very carefully what they're doing on the environment, and will be very, very cautious. So that does tend to impact the way the portfolio looks. However, it's a pretty diversified portfolio. We're big on technology, of course, whether it be software or hardware technology. We're big on consumer products, but we're also in industrial products. For example, we have an investment in a steel tube company in India. And of course, medical is big for us, medical testing, that sort of thing. So there is sort of a bias, but it's not complete. In other words, we do have a portfolio that's reasonably diversified.
And is the concentrated portfolio because there's a smaller number of companies that actually meet the attributes that you're looking for, or stack up well to your expectations?
That's one reason, but more, and of course, you must remember, it's not just a matter of ESG. It's a matter of profitability, of return on capital, dividends, et cetera, et cetera. So we have to have all those in place before we invest in a company. But the other reason for the concentration is that we can then spend in more time. If we have too many stocks, then it's very, very difficult to concentrate and spend enough time with each company, engaging with them and helping them improve. So that's really the reason. And by the way, a concentrated portfolio tends to do better, we found. We get better results.
And I noted that a couple of your stocks were introduced to the S&P Sustainability Index, EM Index. What does that mean for, one, the companies, for you, and perhaps an impact on cost of capital?
It means a lot to us. Of course, it means that some of our work is having an impact. So that's very, very important. But also, by getting in these indices or getting these awards, companies are noticed, and the shareholders who want to invest in companies with high ESG standards will invest and stock prices will go up. So it's a win-win situation that we found.
I note that you hold Clicks Group in South Africa in the portfolio, I think maybe in the top 10. Can you just run through the rationale or the ESG improvement story for that particular company?
Yeah, that company has pretty good corporate governance. They have independent directors on the board. They're very good in communicating with shareholders. They pay attention to dividends. And they generally do a very good job and are aware of the community. So they try their best to behave properly in the community. So they're very high in their standards. And of course, we continue to work with them to monitor what they're doing and make suggestions in different directions. But frankly, there's not many suggestions we can make to them because they've been doing a good job.
Mark, final question from me as we're rapidly, unfortunately, running out of time. But you recently released your new book, The Inflation Myth and the Wonderful World of Deflation. Would you just give us a quick intro into what we can expect in that book, and then maybe what might be the knock-on implications for sustainable investment or the sustainability movement?
Well, first of all, in the book, I outline how the inflation statistics are flawed. They not really a very good measure of what is happening because the basket that they use to measure inflation is changing from year to year, month to month, year to year, and so forth. So this is a real issue because you see the central banks depending on these so-called inflation statistics, which are very, very flawed. So I believe that it's not a good idea to depend on these numbers. Now, it is true that prices go up, but that's a reflection of the devaluation of currencies more than anything else. But the other thing I point out in the book is that we are actually getting better year by year. In other words, the prices of goods and services actually going down, not up. And the reason for that is because of technology. For example, many years ago, not many years, let's say 10, 15 years ago, the cost of making a telephone call was far more than it costs today. In fact, today we can make a telephone call free of charge in many cases. So there's an example of where you have a deflationary environment. And I point out in the book where, and I noticed that I put some statistics of a number of countries where even if you use the inflation statistics, which are flawed, and you look at the average wages, you'll find that in all these countries, wages have gone up faster than the so-called inflation. So there's no use to look at this inflation as a measure of the benefits that people have in the economy. So I believe that what we've got to do is bless deflation. Deflation is actually good, particularly for the lower income people. And of course, technology is resulting in more and more deflation.
Okay, well, thank you very much, Mark. Unfortunately, that's all we do have time for today, but I really appreciate your insights and spending the time with us today.
Thank you very much.